Hello, viewers and investors. Welcome to another episode of Outlook Manage Investment Strategy webinar series. This episode is spearheaded by Yes Securities. I am Kundan Kishore, your host for this session. And today we have a very exciting topic to discuss, that is a strategy to make right choice for in a stock investing. In this episode, we will demystify the essential concepts and strategies to make right investment decisions. To guide us through this insightful session today, we are privileged to have Ms. Nitasha Shankar, Head Equity Strategies, Yes Securities. So welcome, ma'am.
Thank you, Kundan.
So without wasting any time, I will request you to just help us or help our viewers to understand. In fact, what are the right investment strategies which you would suggest to a new investors who are completely new to the market, the stock market?
I think whenever a person enters the stock markets, they need to understand what is it that they are expecting out of it. Now, of course, a very simplistic answer of that is that you would like to make money, but that is not exactly the way stock markets work. Just like any other industry, just like any other science, just like any other business, there is a science that goes behind it. One needs to understand, are you here to make wealth? That is, are you here for the long term? Are you here just to take risk and try and make some money out of it? That is, are you here for short term trading? So it is very important to define what is the eventual goal. Once you define the goal, that is when you decide which strategy really works for you. Of course, if you're in the market for short term and you're only here to make money on an intraday basis, or in fact on a daily basis, or within a week or something, then there is a completely different set of skills that one needs. Typically, this skill would involve, tracking the stock prices, tracking the volumes which have happened, tracking the movement of the stock vis-a-vis the index, seeing how the charts have evolved over a period of time, and then taking a decision. It is very important to have the correct information before one goes ahead and makes that decision. If you're here for the long term, that is that you're planning to hold on for more than a year, and you're here for a longer term to try and grow wealth because you've seen that happening, with other investors, or you've seen that happening in your family, or you typically are that kind of a person that you're saving up for a particular goal. It could be, education of a child, or marriage, or buying an asset, whatever it is. If you're here with the intention of being in the business for a long term, then there is a completely different science that comes into place. And that is typically what we call fundamental analysis. That is, you have to understand everything about the company that you're investing in. Because after all, you're trusting your own hard earned money over there, and just putting money blindly into something which you do not understand is not really something which is very prudent. So it typically, like I said, in short, it depends upon what is the strategy of the person and what is the goal eventually. That would decide whether you're getting into technical analysis, that is charting, or are you getting into fundamental analysis, which is typically going with the stocks and sectors.
That is a very interesting point. That is technical and fundamental analysis. So typically, when a new investors who is just have started investing in a stocks, so what kind of analysis they should follow, technical or fundamental, and which one is better strategy, technical or fundamental?
So I think there are pros and cons to both. Technical, of course, one gets gratification in terms of returns and an exit strategy very quickly. Typically, these strategies are used anywhere between 1 day to 3 months, and they're very effective in that case. So the pro over there, of course, is that you are able to make a short-term decision. You're able to decide when to enter and when to exit. Having said that, it is absolutely futile to try and call the bottom of the stock or bottom of the market, because that's equal to crystal ball gazing. It is very nice to talk about it in retrospect, but that's like driving forward while looking at the rearview mirror, and that's never advisable because all it'll do is to lead to an accident. So if you use technical analysis prudently, then you should be able to make some amount of returns in the short term. Yeah, it could be again, like I said, between 1 to 3 months. But if you are willing to hold on for a long time, now why am I repeating this again and again? Is because most people think that when they've entered the market, the day they enter, they'll start making money, but they don't want to typically take the risk which is involved in it. If you are willing to take the risk, then short term works for you. But if you're not willing to take the risk, it is always prudent to go for a long term investment. And long term investment is always based on fundamental analysis. Now you combine the two. That is that you're investing from a long term perspective, but you use technical analysis to decide when to enter.
Okay.
Now, like I said, this doesn't mean that you're trying to call the bottom of the market, but if you have the money to invest today and you want to go ahead and buy, let's say, stock A, you can check the charts and see, is there volatility coming up in this? Is there any kind of a fall coming up in this? Is there any kind of an event-based, fall in volumes or increase in volumes at selling price, so on and so forth? You realize that, okay, you are seeing a lot of volatility coming in. So let's just hold off my purchase right now and probably buy it a week later. Having said that, another way of using technical analysis, prudently, if you're looking at fundamental analysis, is that if you see that a stock is now entering its consolidation mode and it has been going up for a pretty long time, prudent to take out some of your profits out of it and let the rest of your capital ride. So a combination of two is something which becomes quite useful because both sciences, both fundamental analysis as well as technical analysis, obviously have their own merits and their demerits. Demerit, of course, for long-term investing is that you need to have patience, and a lot of people do not have that. So unless and until you have the patience to observe the stock till such time as the fundamentals play out, one typically does not really get into it.
Okay, so basically you mean to say that if somebody has just started investing in the stock market, they can do some tactical allocation through this technical analysis, and if somebody is having long-term investment goal, they should go with the fundamental analysis.
Absolutely, absolutely correct. That's how one should look at it. And if one doesn't want to take any such call of tactical allocation or anything, then just use the SIP mode. It's a very nice systematic way in which your investments are being done periodically, consistently. Doesn't matter where the prices are going, and eventually one will benefit if you're looking at the long-term way.
Okay. So, ma'am, typically in investing, there are two broad investment strategies. So one is, say, uh, I mean, that is top down, and another is bottom up. In top down, you just first identify sectors and then you uh, go for stocks. While in bottom, you first identify stocks. So which one is better strategy if somebody is just planning to invest in stocks, and which one works better?
So I think in the long, what we do typically is, I can talk about myself because again, there are merits to both. You can look at a bottom-up approach or a top-down approach. Typically, in a bottom-up approach, you start from the company. You shortlist the company basis, your fundamental parameters like ROC, incremental ROC, valuations, debt to equity. There are several measures that one can use. So once the company has been identified, you thoroughly research the company, see whether, what are its business prospects, how the management has been shaping up, what have been the capital allocation strategies for the company, which sector is it operating in, and is it seeing any tailwind or not. So that is typically how one goes about the bottom-up approach. Another approach is, of course, top-down approach, wherein you see which are the sectors which would benefit from where you are in the macroeconomic scenario. And within that sector, you try and identify which company to invest in. Again, two different strategies, and they work very well depending upon, what is your eventual theme of investing. If you're looking at a valuation kind of an approach, then bottom-up approach to investing works very well. However, if you're looking at a thematic sort of an approach, then a top-down approach works well. So if I'm looking at, let's say today, everybody has been talking about a lot about green energy and clean energy. So it is a trend which is there, and the government is investing towards it. A lot of policies are being made towards it. So if I want to typically invest in companies which would benefit from green energy, then a top-down approach would work. Because then I would decide, okay, this is the sector, green energy, what are the trends in it? Is it only for power? Is it only for companies which are supporting power, clean energy power? Is it about companies who are ancillary to it? Or is there a proxy play towards it? So on and so forth. Once the trend has been identified as to which which part of this subdivision of the sector is going to prosper, then you can decide as to which are the best companies in it, and then research those companies thoroughly and then compare them with the peer and at the right valuation enter. So it typically depends again on what is it that you're wanting out of it. If you're looking at valuation based approach, then a bottom up approach typically works, and if you're looking at a thematic based approach, then a top down approach at work.
So which one gives better return?
They both give very good returns in their own time. Valuation approach has worked very well if you're looking at a top down approach, sorry, a bottom up approach from about 10 to 12 years perspective. Thematic approach, of course, gives you very good returns when the particular theme is working from 2 to 3 years perspective.
Okay, but ma'am, it's very difficult for a layman to identify the emerging theme. So what should be, I mean, how one can identify the particular emerging theme in earlier stage? Typically, you identify the theme when that particular index has gone up, say 20%, 30%, 40%. Then investors get to know that, okay, fine, this theme is working. So how to identify the theme in earlier stage?
So one thing is that you need to be very well read, because if you're tracking the newspapers and you're tracking what is happening around you very closely, then it gives you typically suggests which trend and which themes are going to be coming up. So for example, I'll go back a couple of years. The demonetization was a very big hit that pretty much everybody took. And just post the demonetization, the GST was introduced. Now, instead of looking at why GST has come through, why demonetization has happened, what a good analyst would typically would have done, or a good investor would have done is, okay, GST has been introduced, it has become a reality for us. What will happen post this? Now, the obvious answer to this is that everybody has to pay tax, depending upon which segment you are in, depending upon what percentage you have to pay. Now, if everybody has to pay a tax on what they're selling, then the price advantage of me paying cash to somebody vis-a-vis me entering a proper, organized shop, that price difference is going to slowly and steadily go away, which means that the demand is going to shift from the unorganized sector to the organized sector. Now, this theme became a reality on the day GST was introduced. All one had to do was to figure out which are the sectors where unorganized demand is high. It was typically towards groceries, that is your, retail, your clothes, your jewelry. All of these things saw a lot of unorganized demand which existed pre-GST era. Now, obviously, post GST, these are the sectors which have typically seen that migration happening. Some have seen it happening almost instantaneously, but some have seen it happening over a period of time. So these are the kind of events that investors typically need to watch out for. The union budget is another one of the biggest events. I know that over a period of time, people have lost interest in the budget because they believe that most of the policy announcements happen outside of the budget. But even then, the budget is a very important event. Uh, like last year, it became a very infrastructure capex heavy kind of budget, wherein a lot of announcements were made towards investments in roads, towards investments in ports, so on and so forth, other infrastructure areas. It was pretty obvious that if the government is going to do all that spending, that money is going to be spent somewhere. Someone will benefit, someone will be getting those orders, and someone will be executing those orders. Right. Again, someone has to supply to those companies to execute those orders as well. So the trend of a building material company benefiting from it just came out of it. So one needs to think these things through.
Right.
if an announcement is made, that is just like, the top of the cake, and you have to figure out which are the areas one can look at. So reading, very important. Uh, Processing the information that is given to them, very important as well. And if all else fails, then they can always look at a professional advisor to help them through this.
Okay. So now we solve the problem of the person who is going for top-down strategy. So if you can just help us with the investor whose approach is just bottom up. So in that case, how to identify good stocks?
So in the bottom-up approach, things actually become quite interesting because one needs to be good with numbers. Now, where a very good starting point is to try and figure out where is a valuation mismatch. Now, the best way to try and figure out where is the valuation mismatch is to run a screener to see, companies who have actually increased their return on capital employed. That would take into account, whatever businesses they're doing, how much of debt have they raised, so on. It's like a holistic approach towards it. So you can take out what are the ROCE that the company has gone, and incrementally has it been higher or lower. So is it positive or is it lower? So if it
Okay.
is positive, obviously the company has been generating wealth, and if it is negative, it means it has been destroying returns on capital employed. Those can be typically ignored when you're looking at bottom-up approach.
Right.
Once that screener has given you all, shortlisted your space, you can run further, screeners on the same to try and figure out what kind of cash balance do they have, what kind of margins do they have the margins been volatile, have the margins been stable, what has their operating performance been over the past 5 years, what is the cash flow that the company has generated. So when you keep on running these screeners on the same set of companies, you'll eventually have a shorter list and you'll be left with about 15 20 companies. On that, you can always try and figure out what the valuation metrics is. Is the valuation lower as compared to their historic valuation? Is the valuation lower as compared to their peers? Is the valuation low just optically as well? Once that screener is run, it gives you a shorter list, typically of 5 to 10 companies, which is what an analyst or an investor typically starts with. Then delve in deep. How has the business been? And there's a lot of information available in most of these company websites. There is an investor center over there, an investor relations tab, which you can find in the company's website. These tabs typically contain information of their historical annual reports, historical financial statements, historical company call records, their presentations. All of these can be studied in closer detail to figure out whether what the prospects of the company are going to be going forward. Management's update is, of course, one of the best ways of trying to figure that part out. Now, if all the prospects look good and you have done your study, you've spoken to the management, if that opportunity comes in, talk to the management, talk to their suppliers, talk to their competitors. That is when this list of 10 will pretty much narrow down to about two or three. Once that happens, you can decide how much money you want to allocate. Do you only want to buy one? Then please take the cheapest one. If you want to buy two, three, then you can always allocate your money according to that. So that is how a typical bottom-up approach would work. It requires a lot more thinking, a lot more studying, a lot more analysis, but in the long run, it has worked in many of the times.
Okay, very well explained. But here my question is that if we go by valuation perspective, at times valuation, I'm not at times, many times valuations are very misleading. I'm just giving you one example. For example, if you look at banking stocks, especially PSU banks stock, though they have run up in recent past. So if you typically look at the valuation, they will always look, cheaper. When you compare that with, say, FMCG companies or some other or companies in some other sectors, their valuations are very high, but the growth perspective is also very high. So in that case, how investors can just uh, get to know that, okay, fine, this is the right valuation I need to pay for this company.
That's a very good question. So typically when you're looking at valuation, it is not prudent to look at it as a standalone metric.
That's right.
always have, see, valuation is something which is always relative to something else. Relative to the index, relative to the stock's previous history in itself. So one very good metric one can do is to look at a 10-year average of a stock. So I'll talk about a sector instead of talking about a stock, but the same proxy can actually be just extrapolated to a stock as such. So if you look at the 10-year average for FMCG stocks on a PE basis, it has been roughly around 14 times. And currently, the sector is trading at about 51 times, which pretty much means that it has become expensive relative to its own valuation.
Correct.
Now, if you look at the ROE, in this case, of course, because most of them typically do not have that much debt, if you look at the ROE, it has ranged between 21 to 22% if you're looking at the historic, 10-year average. Whereas currently it is at around 24, 25%, depending upon which companies are you looking at. So there has been an increase in ROE, but there's also been a substantial increase in the valuation, which pretty much means that all the incremental return on equity is priced in at the current price. So you should ideally wait for it. So it is expensive, compared to its history. It's expensive when you're looking at it in comparison to its own ROE. On the other hand, if you're looking at a sector, let's say, which one? Let's say if you're getting into telecom, telecom
Telecom.
is a sector which has
But
got
that's
a lot
very
of
small.
investor interest in
Yes.
recent times. If you're looking at that, I think the PE about 10 years, if you're looking at a 10-year average, was around 19 and a half, 20 times.
Yep.
Whereas currently it is around 14. I think 14x was the last that I saw.
Mhm.
It's a little dated, but it'll be about 14x. But if you look at the ROE, that has gone up from about 17% to about 19%. And ROCE has improved as well. So, which pretty much means that there is still a lot of value that one can play looking at its own historic average. Now, obviously, for telecom, P would not be the right metric. EV/EBITDA would probably be a better metric, but one can decide. So, telling you that telecom still has a lot of value that is still left in it. Similarly, for companies, one can typically look at historic valuation, compare your current valuations to that. If the company is looking cheaper and vis-a-vis its own history, then obviously one can delve into it as to why that is happening. And other metrics have already improved. That means that is not being priced in. On the other hand, if it is already trading too expensive and the other metrics are either flat or negative, then obviously it doesn't make any sense to look at it. So valuation in itself always has to be looked at relative to history if you're looking at bottom up, and relative to its own peers when you're looking at top down.
Okay. So now valuations is pretty much covered and in a very nice way and very informative way. So please help us understand how to, how to handle the volatility.
One thing to do with volatility is that it is always a lot of noise. If you are a long-term investor, just cut the noise. Please turn off all your TV, your television especially, because that tends to just add on to the noise part of it, and focus on what you're doing. That is the best way of looking at it. If you are a short-term investor, please use the volatility to your favor by using the right technical analysis. Even then, I'm not saying that volatility will be brought down to zero, but yes, it can be used to your advantage. Or ignore both and just start doing a systematic investment. You will be taking care of volatility over a period of time. Yes, initially you may see certain amount of pain, but volatility is actually your best friend.
But ma'am, the volatility is done, but there is another problem that many investors face, including me, that when is the right time to exit from your investment? If you can just help us on profit booking part, when is the right time to book profit from a particular stock or particular sector? Because
So I
investing
think
is
the
one
best
part.
answer for that would be, what is it that you want to do? Why have you entered the market? What is your goal? If your goal is to make 20% out of your money, then please exit the moment that goal is reached, because that is how one needs to look at it. Second time to exit is that whatever you thought of, best of analysis is never 100% accurate. It can go wrong. So if the management changes, something happens to the business, there is an unforeseen war that happens somewhere in the world because of your raw material got constrained. COVID happens, which is, which was one of the worst phases of anybody. And the fundamentals on which you had entered the stock, they change completely. They change drastically. Best thing to do is to just exit the stock there and then. For profit booking, you have to again figure out why are you there. I mean, just because you're seeing a 10% profit happening, but you have invested in the stock from a 3-year perspective, you don't need the money. So please do not exit from the stock. Let the money remain. Till such time as the fundamentals and the price are at discrepancy to each other, one should remain invested. The moment they converge, it is the time to exit. Or if they completely diverge because of like I said, extraneous events, then one should exit. Otherwise, remain invested.
So what would be your advice for investors in this current market scenario where they should invest now?
I think any time is a good time to invest because there are so many opportunities which are always present in the market, no matter what level. I mean, I know a lot of people look at the index levels when it comes to investing, but no matter what the level is, any time is a good time to invest. And there are so many stocks, so many things that one could look at. If we were looking at, again, I'll talk about a top-down approach because I don't really want to get into a stock-specific discussion. But if one were to look at a top-down approach, currently there is a lot happening on the infrastructure side. There is a lot happening on the capital goods and manufacturing side because there is a lot of capacity utilization that is improving over there. There's a lot of capex happening there. Power sector has started looking very attractive, especially since most of them have actually started announcing plans for capital investment towards clean energy, green energy. The demographics are favorable for consumption, especially premiumization of the consumption side of it. And purely on the valuation perspective, I do believe that healthcare looks very attractive as well, especially pharmaceutical companies. Of course, one has to be very stock specific in these sectors rather than taking the call on the entire sector itself. But these are just some of the sectors which we find quite attractive right now.
And what about FMCG?
That's why I said demographics are always in favoring consumption, both on the FMCG side of it as well as the premiumization side of it.
This was indeed a very informative session. We hope our viewers will benefit from this. And thank you so much, ma'am, for your time. We really appreciate.
Thank you so much, Kundan. Thank you so much for calling me. Thank you.
Viewers, we hope you have enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestions and questions at editor@outlookmoney.com. We will be back with our next episode very soon. Till then, stay safe, stay invested, and keep following Outlook Money, your personal finance magazine. Thank you.